We are starting our session. I hope after lunch everyone is energized to start the new session. Our next session is on the impact of harmonized regulation on the microfinance sector. So I will now invite our moderator and eminent speaker on the dais. Today, our moderator is Mr. Manoj Sharma, Managing Director, MicroSave Consulting. Our first speaker is Srimati Veena Srivastava, General Manager, Department of Regulation, Reserve Bank of India. Our next speaker is Mr. Muhammad Fazlul Kader, Additional Managing Director, Palli Karma-Sahayak Foundation, Bangladesh. Mr. Shalabh Saxena, MD and CEO, Spandana Sphoorty Financial Limited. Mr. Aditya Chatterjee, Managing Director, Equifax India. So now I will hand over the session to Mr. Manoj Sharma, our moderator. Sir, please start the session.
Thank you, and thanks everyone for joining in. We have a very a great panel and also a very diversified panel in the sense that we have regulators, we have experience from Bangladesh, and we also have sort of microfinance experience in terms of how the regulations are actually impacting the sector. And of course, we have the credit bureaus brought in by Equifax. So without further ado, I'll start. And I'll start by basically telling you the story as I saw it of the growth of microfinance in India and how it all started. Because I had the privilege of being a junior officer those days in SIDBI, where it all started. And so I had the sort of privilege of watching it from the sidelines to see how the sector took shape. And the way it happened, of course, was that Bangladesh is the pioneer, started the whole the Grameen methodology, the Grameen Bank. And of course, SIDBI officers visited Grameen Bank and saw how it worked. And the idea was to replicate some of it in India. But of course, there was nothing called microfinance institutions those days. So SIDBI basically corralled a group of NGOs, and the likes of Share, Spandana, whatever you saw of it those days, actually used to be NGOs working in a very diversified set of fields, none of them in microfinance. And the whole idea was that SIDBI basically brought them in, gave them the technical assistance, the capacity building that was required, but also gave them the risk capital that was needed. And I think that was very important because most of these NGO founders would come and say that this is not our cup of tea. This is not what we have been used to do. How can you expect us to take the risk of lending to somebody? So SIDBI assumed a lot of these risks. And of course, in parallel, we had a competing methodology through another public sector undertaking, NABARD, which was the SHG bank linkage. But for now, I'll focus on what was going on in the microfinance world. But other than that, what SIDBI did, and we have Mr. Bridgmohan who used to lead a lot of these efforts those days. And the other thing that SIDBI did was it also looked at building the ecosystem for the sector, which was to say that there was no rating agency then. And the mainstream rating agencies were not ready and willing to look at this as a sector. So actually MCRIL was brought in, a rating methodology developed with MCRIL, and MCRIL I think was given some 25,000-30,000 rupees per rating, which only SIDBI used to consume. So it would give the money, take the report, and then on that basis, make the loans to a fledgling NGO MFI sector that was coming up. So SIDBI spent a lot of time and effort in trying to build the sector, in trying to create the ecosystem. And whatever we see today, that $38 billion of loan outstanding is there through the microfinance sector, is largely an institutional building effort that happened. Had SIDBI tried to do everything itself and run with the sector on its own, I don't think we would have got to even halfway to what we have got. Yeah. But as part of this sector building, one of the efforts always used to be that SIDBI used to go to RBI and say, please regulate the sector. And every time RBI would say that you are not even 1% of the credit outstanding in the market. So what are you talking about regulating? What is there to regulate? It's such a small sector. It's a rounding error in the entire sort of trillions of dollars that is there in terms of the overall credit outflow that's happening from banks. And that all changed with the Andhra crisis, because suddenly the realization dawned that even though the credit is not 1% of the total banking sector assets, it is still spread very widely. It is still spread in a sector that is very politically vulnerable and also very politically active. Yeah. So you can't ignore a sector like that, notwithstanding the size of the loans. And that is when, of course, the famous committees got constituted, and we saw a set of regulations coming in which had a lot of constraints, because the regulations were born out of a crisis. So we had a crisis, and the regulations were a response to the crisis. And anything that happens in a period of crisis is always sort of very short string in terms of the bandwidth that it gives. And that's what the initial microfinance regulations were. And I think as time went by, the sector grew. A lot of the guardrails that were missing in terms of credit bureaus getting much more active, the whole Aadhaar system enabling us to track borrowers. Now, of course, we have gone to a whole new level with household level tracking mechanisms, and we'll try to find out from some of our panelists on how that is working. I think all that changed with this set of regulations. The RBI has said that, okay, we give you a lot more freedom to operate, provided you operate within a certain set of guardrails, and to ensure that at the household level, this chronic challenge of over-indebtedness that we hear from time to time does not happen. So I think with this, I'll turn to our panelists. I mean, this was the background I wanted to link up with where we started, where we sort of landed in between, where it looked like everything was sort of lost, because Andhra used to be the sort of crown jewel in the microfinance industry. And from there, actually, not only rebuilding, but rebuilding with much more strength and capacity to getting to where we are, with the central bank having the faith in the sector that it is allowing for a lot more leeway in terms of how we manage the microfinance sector. So let me sort of move with this to Madam Veena Srivastava from the Reserve Bank of India, and ask her as to what is the thinking behind the entire, this harmonized regulations, as we call them. What led the RBI to say that, okay, we are now ready as a sector, and probably the regulations also demand that we come up with something like this. So I'd pass this over to her and ask her for her comments.
Good afternoon, everyone. Like Mr. Manoj has given very interesting background. And when we think about the microfinance sector, it's no more MFI, no more microfinance institutions, because now we have the variety of lenders. It is the banks, it is the SFBs, it is the NBFCs, which are other than the MFIs. So really interesting to listen to it. And now when we talk about the new regulatory framework, the new which came out in March 14, 2022. So that is really quite different from what we had designed in 2011. So when we talk about I will try to, this regulatory framework has been discussed threadbare at different forums over a period of time, means in recent months. So what is the rationale behind making this regulatory framework? So certain points I would like to touch upon. Here, the main points which I would like to touch is the over-indebtedness of the microfinance borrowers. That was the main issue which we felt that it has to be dealt with. Then the second point which I will dealt with is enabling competition in the pricing of microfinance loans. And third is a strengthening of customer protection measures, and fourth is the how the regulation provides the flexibility to the microfinance lenders. So when we talk about this over-indebtedness, no, there were a lot of regulations, it was given to the microfinance institutions like 1.25 lakhs, a loan can be given to the individual borrowers. But when we look at the regulation of 2011, there were 2 points missing, where the microfinance loan limit was given for the per borrower, but the limit was looked at the, that income limit was looked at the household level. So that was not gelling well. And the second and the more important issue was loan amount was not linked to the household income. So what we have done now, that income is assessed at the household level, as well as the indebtedness is also assessed at the household level only, and the total outgo, that is the payment of interest as well as the repayment of principal, is assessed at the, capped at the household level income. And second thing that what we have done, that what we expected, like when we came out with the regulation in 2011, we thought like it will that lenders, while doing their internal credit assessment and risk management processes, they will look into the debt income ratio. But that was not done, and that is the main, when we talk about the indebtedness, we have looked into this aspect, that the indebtedness of the borrower should be completely linked to the household income. And this 50% level is not, is very, like when we capped at the 50% of the household income, it is not a random number. We have, a lot of thought has gone into it, and I'll give you some of the thought process while we decided the 50% level. It is a low savings of these low income households. They should be having in hand some of their savings to basically spend on their other requirements, like they will be having the need in case of emergency, essential services, and moreover these household income, these small like low level household, no, they will be, it is not the formal financial institutions, they are not the only source of borrowing for them. They may be having from their friends, they may be having from the family members, or they may be having loan from their employers as well. So that also has to be returned. And similarly, it is possible that these small, low level households, they may be, while you do assess their household income, they may be giving very, they may be exaggerating their income. So it is better to cap it at a slightly lower level. That is why the level of 50% was decided. That was the one point. And then we talked about, the second point was that pricing part. How do the pricing regulation is bringing in the competition among the lenders? So here we have removed the cap. But removing the cap, that does not mean that the pricing has been completely unregulated. And why did we remove the pricing cap? Because it was, when you see the situation in 2021, over a period of time, the share of microfinance institutions has reduced to just 30%. 70% lenders were non-MFIs. So this pricing cap was applicable to only this 30% of lenders. It was not applicable to the 70%. So there we say, when we say harmonized, it is one of the main points where the regulation was harmonized. But at the same time, what we did, we brought in a very this simplified fact sheet where we have told the lenders to give all the details which goes into the pricing of the microfinance loan, and where if you look at our guidelines, there is an example given where we have told that all the numbers has to be given in the absolute number except for the effective rate of interest, so that it is easier for the borrower to understand like what is he is getting and what he is required to pay. So that was one point. And then we have also said that and the other regulation like cap on the repayment obligation as a household income, as a percentage of household income, that will be working as a like restriction on the lender when they are deciding about the interest rate. And just one point, like I will try to give just one more point, which is along with this fact sheet, what we have introduced that no prepayment penalty. So when you look at these two things together, like this fact sheet where through which the borrower can learn about all the details like the effective rate of interest, along with the no prepayment penalty. That means if any lender is giving them the loan at the higher rate of interest and they are able to find out like it is some better rate they are able to get from other lender, so they can immediately switch it over. So it will work as a pressure on the lenders to keep the interest rate at competitive, means competitive rate of interest. They cannot charge high rate of interest. And then towards the conduct part, there was like what was the main issue when about that coercive recovery practices. It is basically coming through due to the higher indebtedness. And indebtedness we have tried to cap it through cap on the total outgo from as a percentage of the total household income. So now here what we have told that for the borrower it has to be a mechanism for proactively, like when there is a borrower is stressed, then this MFI lender should be engaging with them to try to find out and try to help them out and what is the reason for their indebtedness. And second part is what we have said, that dedicated mechanism for the redressal of recovery related grievances. And fourth point, what we have talked about is flexibility to lender to design the products and services. So earlier, if you look at the earlier guidelines, there were a lot of restrictions, like loan restriction. Then we used to say that first phase, it should be 75,000 crore, then tenure of the loan, where we said that loan of 30,000 should be having minimum tenure of 24 months, then the purpose of loan, that minimum 50% should be for the income generation and all. So all those things have been withdrawn. That means we have given the flexibility to the lenders so that they can design their own products and services. So that's all from my side.
Thank you, ma'am.
Thank you.
Thank you very much. Before turning towards the practitioner, I'll just quickly go to Kader bhai, who is from PKSF in Bangladesh, because a lot of the, at least the initial model that we have, and actually the existing model of microfinance that we have, we sort of inherited it or we adapted it from Bangladesh. So I'd like to hear what is the regulatory landscape in Bangladesh? I mean, how has a sector which is a pretty thriving sector in Bangladesh, how have regulations evolved there, and what is the current state of regulations there?
Thank you, Manoj bhai. It is always very refreshing to come to India. Thank you, Gigi, for inviting me to come to here. I will share our experience regarding regulatory regime, evolution of regulatory regime in Bangladesh. It would be very interesting to understand the spirit of regulations in Bangladesh, because it is quite unique and a bit, I think, we adopted a different path than India, which is not, I would not say that intrinsically different, but on the periphery it's quite different. For example, in Bangladesh, the microfinance institutions, the regulatory regime passed through 3 stages. At one stage, for about more than 2 decades, it was informal. And then for about 1.5 decades, we passed through a semi-formal type of regulation. And then from 2006 on, we switched over to formal regulation in Bangladesh. How that happened in Bangladesh? But in Bangladesh, the microfinance drew attention of public policymakers due to its claim as a effective poverty alleviation tool in Bangladesh. And later, we thought that at the early stage of microfinance, the poor people are a very homogeneous group of people. And later we found that as we entered in the arena, we found that we are dealing with a highly heterogeneous group of people. This group of people, since colonial time, I mean, all these successive governments were very interested to finance their self-employment activities. As you know, Bengal went through some famine-like situation in history for a number of times. And since that part of the world was not industrialized, all the successive governments, they were interested in ensuring self-employment because of absence of industrialization. So from 1905 to late 60s, or I'd rather say early 70s, we tried to reach these targeted poor people, so-called poor people, through different types of cooperatives and failed. In 60s, we undertook a study and found that about 10% of the people were reached by microcredit, which the subsidized fund given by the government to reach the targeted poor people through cooperative mechanism. And only 10% of targeted people were reached. Soon after our liberation in 1971, from 1973 to 76, we had 3 projects. One of them emerged as a very world-famous project, which all of you know, the Grameen Bank project. So it took us about 70 years to learn that we need different specialized institutions to cater the needs of poor people, because the commercial banks and cooperatives, they are not designed to cater the needs of this particular market segment. The financial market is, like other markets, is very segmented, highly segmented, and banks and NBFIs are not designed to cater their needs. They are designed to cater the needs of a different financial segment. And so that is why we learned 3 features, fundamental features of a new set of sustainable institutions. Number 1, it has to be an institution. Institution means sustainable organization, which is meeting a social demand effectively and efficiently, sustainably, and by recovering all of its cost from its operation. Earlier, prior to that, the traditional notion about poor people was, we used to say in Bangla, ahare gorib, poor people, they don't know anything. So if you give a loan to them for self-employment, first of all, you have to give them training, because they don't have any skill. So there was a paradigm shift in mid-70s in that philosophical notion. We recognize that poor people are not ahare gorib. They have a skill, they have unutilized capacity. And we need a special breed of financial institutions called microfinance institutions, which will have undiluted focus on serving the poor people. That was the spirit basically, and the pricing of the loan is, has to be sustainable. That means, they must be able to recover all of their cost of operations from their revenue earning. So we have to, the mandate was what we learned in a heavy way is we need to create a separate set of institutions. We tried, cooperatives, banks tried to drag them into microfinance, serving the poor with many kinds of incentives, guarantee fund, this, that, and failed. So when PKSF was formed until 1990, early 90, this was recognized as an informal sector, fully self-regulated organization. And apart from Grameen Bank, other NGOs who were trying microcredit were not very sustainable. And during this period, 80s especially, 70s and especially, donors especially supported these NGOs. And these MFIs, NGOs, they didn't have a sustainable microcredit program. So after a long, about 7 years of dialogue, PKSF was formed. And from 1990, PKSF emerged as a quasi-regulator in Bangladesh. They blended finance and institutional development together and emerged as the quasi-regulator, setting the performance standard for MFIs. And we got involved in institutional financing of NGOs to transform them into MFIs with the so that they have the required values of an institution for serving the poor people sustainably, not commercially. So from 1990 to 2006, this period was a period of consolidation. I'd not say consolidation, emergence of microfinance as a solid sector, as a farm, which have got strong root in the soil of Bangladesh. We, PKSF, shaped the microfinance sector of Bangladesh, led by the NGOs, not Grameen Bank. In late 90s, many fake NGOs started emerging in Bangladesh, getting away with people's money, and the general people, they had a negative notion about started developing a negative notion about the MFIs. They might get away with savings deposits. So from late 90s, we thought that we should have a proper regulating agency. Again, we get involved in the debate that whether self-regulation versus external regulation. And finally, there was a consensus built that self-regulation is a different thing. Regulations means always external regulation. There must be a regulating agency. And then the issue came whether central banks should regulate this sector. So as I've said, banks have a long history as financial institution, maybe about 400 years. This is a matured sector. And for them, central bank is there. But the microfinance institutions as a new breed of financial institutions, they are in Bangladesh still, I would say, in late teenage institutions. And all of us know, the older people, it's very hard to raise teenage children. So we thought that we need a different type of regulatory organization which will create an enabling environment so that MFIs can start getting matured to serve the diversified, highly heterogeneous group of disadvantaged people of different sorts. There are farmers, ultra-poors, micro-entrepreneurs who can undertake growth-based economic activities, which we call in Bangladesh micro-enterprises. There are IGS. These are income-generating activities, which we call the partial employment-generating activities. And for them, we have the typical microcredit. So for these organizations, we thought that different regulatory regime should be created, and MRA was created, Microcredit Regulatory Authority was created in 2006, but their regulations were circulated in 2010. It took about 4 years with the assistance of PKSF. And the idea was actually as I've told, these MFIs are not they are not merely involved in financial intermediation. They're involved in social intermediation also. And through a long, rigorous way, we learned that finance alone cannot create magic for poverty alleviation, because as I told earlier, that the policymakers gave importance to microfinance for its development role. We switched from poverty alleviation to growth-based economic activities later. It is through our evolutionary path. So we combined many non-credit services with finance so that finance can work, finance can create magic. Because if a number of things, do not happen together, then in a concerted manner, finance cannot create any magic. And that's why our MFIs, they're involved in intervening in the value chain development of programs, brand development of the different micro-entrepreneurial business clusters. They're even involved in cultural development, cultural activities, there's a long history.
Yeah, I'll come to you, Kader bhai. Bangladesh is, one of the things about Bangladesh is it's a very diversified market. First of all, they're allowed to do savings, and I think that itself brings in a whole new level of regulatory paradigm. And as Kader bhai touched upon, they're still an NGO sector, unlike India, which went the for-profit route, and where RBI said, if we have to regulate, then you have to come within our regulatory formats that we are comfortable with. So you had the NBFC MFIs, you had the small finance banks, and eventually the banks also getting into the act. Unlike that, microfinance has continued in Bangladesh to be a sort of a much more social sector. And I think it drives on the back that there are savings are allowed to be leveraged. Whereas in India, we largely leverage a very large asset pool from banks, which is again possible due to the priority sector guidelines. So I think we have a very different sort of context, and as Kader bhai said, it's a different environment, and it's good to see how that has also been brought under a regulatory umbrella. So let me move to Shalabh Saxena from Spandana and ask him, and I can see other MFI CEOs are there. Dr. Hegde is there, HP Singh is there. I'm sure there are a few more whom I'm not able to see. I'd like you to come in when we open the floor, saying what is working, what is working but not working so well, in this harmonized regulation. I'm sure that, as MFIs, there will always be ye dil mange more. So while the interest rate cap has been removed, which I think is a very, very big development. But what else? And I would like Shalabh to kick us off there on how things are going.
Yeah, so good afternoon to all of you. First of all, just a small point in terms of the new regulations. It's now 6 quarters. The transition period is now over, and I think as institutions, and all the institutions, I think all of them have kind of matured and evolved to a stage where the execution, whatever were the disruptions, have been taken care of. In fact, at an industry level, I don't think it took too much time. So the transition part is over. That's point number 1. Point number 2, and which is a very big thing, is I think this was the need of the hour. Ma'am really took a lot of time in terms of explaining why the regulations and what was the background in terms of how were the norms formed. I think it was well thought through, as it turns out in hindsight. It was a very well thought out, whatever is the framework in terms of how we are operating. It puts a formal method to the way things were going, number 1. Number 2, most importantly, the concept of capturing the household income and liability, I think, is a great one. Because what it does is it extends the scope, and yet it gives some way forward in terms of if you want to lend, while it is the risk appetite of the respective institution as to how you want to do it, but it's very important that you should know, which way you are going. The fact that today, when we lend, we know what is the indebtedness at a household level, I think is one of the biggest win as far as these regulations are concerned, and my compliments to the regulator on that. In terms of what is going right, I think, the industry has adapted. Yes, the rejection rates could have gone up for sure, but I think in the long-term perspective, if you take a long-term view of the industry, I think, it's absolutely welcome. From from a company point of view or an institution point of view, what it also forces you to do is to become a prudent lender. Ultimately, whatever goes has to come back, and hence it's very important that you calibrate. Good to kind of look at AUM and the AUM growth, etc., but it's always good to moderate. We are not playing a T20 match where everything has to be over in 20 overs. You have to take your time. You have to build your, you build your steps and then slowly move towards progression. One last point in terms of the market. India still has unique borrowers, about 70 million. So there's a lot of headroom. And this goes back to the point I was making that, one has to calibrate the ticket sizes and the amount you lend, because there's enough room. You are still at a various 40, 45, 50% of the household penetration. You take a number, there are various research studies, which kind of give you a 40% or a 50%. Even then, even if I take the most conservative, which is a 50%, you still have a headroom which is fairly available. So at an industry level and at a company level, I think, it's a great step. We are moving in the right direction. Slow and steady wins the race, and that's what we are planning to, that's what as an industry we are moving to. And, over a period of time, what has happened is that the entire operating environment for the industry also has matured. Typically, who are the people who kind of make this industry? There's a political establishment, there's a executive, there's a judiciary, there's a customer, and there's an employee. Broadly, these are the 5 pillars which kind of drive the, drive the industry. 2.5 decades of experience, people have matured. So, hence you see a lot of balance in the industry amongst the people. Yes, there's always, scope for improvisation, which I'm sure everybody is doing. But broadly speaking, I think, we're on the right track, at the right pace. Good for the regulations that there's some, there's some science to whatever was happening. The industry is projected to grow today it's at 3.6, 3.7 lakh crores, slated to grow at 20%, which is fantastic. So that's where I would want to close.
Thanks. So very positive sort of uptake, I would say, by Shalabh, if you were to take this as an industry response, even though, as I said, I'll open it up to the floor. Let's now hear, as Shalabh pointed out, one of the key sort of changes that has happened is that instead of linking it to individual income, the RBI has actually gone a step further and linked it to household income levels. And I think that's very, very important, because we know that income is fungible, especially in this category of economic strata of people. And this applies both to probably income and also to loans that have been taken. So I think linking it to the loan amounts to household income level is a great step. And with that, I'd like to turn to Aditya Chatterjee, who is the MD for Equifax, and say that, so how do you determine, household income? So while it's a great parameter, how do you go about determining it? And how do you go about determining household indebtedness? Because now you're talking about, Aadhaar is an individual's identification ID. It's not a household level ID. Some states have household level IDs, or at least have tried to get to household ID levels, but really it hasn't gone very far. So how do you go about doing it?
Sure. Thank you. Good afternoon, everyone. So before I come to the household part of the question, let us take a step back at another great thing that RBI had done, which is the combined footprint of that individual in both the retail and the MFI bureau. So that is where we as bureaus actually started to have a combined view of the individual, both with the footprint in retail and the footprint in MFI. Currently, 2 years back, this combined footprint was about 7 to 8%. But currently in some asset classes, we are seeing as much as 30-35% overlap of the same individual who is both in the MFI bureau and is also taking retail loans. So firstly, this is helping a lot. For example, let us look at the retail lenders first. I mean, you talk about two-wheelers or tractor or agri or any of these type of loans. These pure play retail lenders are also looking at the MFI footprint of the individual. And then when you go to the MFI as well, who are trying to graduate or up these people from joint loans to individual retail loans, they are also looking at it. So I think the first real innovation which came was the combined credit report. I can confidently say that from a bureau perspective, at least 90% of the reports that are pulled today are the combined credit reports. And it's just a matter of time, it's just a tale. Very soon we'll have 98-99% of the bureau in the combined credit report, right? So that was the first innovation and the segue to the next part that we have done, which is the household. So this was something, I think the bureaus like us, we went live around December, January of this year, which, as all the speakers spoke about, looks at a single consolidated summary report of the entire household, which is the husband, wife, and the unmarried child, as we all know, right? So this enables the lenders to have a single view of, first of all, what is the total indebtedness of the household. That's point number one. Second, of a single view of the scores or the credit scores of not only the primary lender, but also the other household members, right? Because the entire consolidated credit scores are given on that. And also helping you calculate the 50% FOIR that we all spoke about, right? The another point that I will say and I will admit is that this household definition is a work in progress, will only get better with time, because we are dependent on the data that we receive. And this, as I said, it started from January, it's work in progress. If we take an industry view, currently what we see at an industry level, the household size is coming to around 1.9 to 2. We believe that will only increase with time, with better and more reporting, right? So maybe it will take another 12 months for it to reach a maturity level. That's my assumption. But very soon you will have an established household size. Maybe we can give you the household size analytics by geography. Maybe we can give you the household size analytics by ticket size. We are a bit away from that as things stand today. It's work in progress. But with the great things happening, it's just a matter of time. So overall, that is my views. We are working with a lot of MFIs who are taking this household report from us, who are giving us this entire household data. There are a lot of POCs happening, and I'm sure, as I said, in 6-12 months, it will be a totally consolidated and a matured product that the entire industry can use.
This is a very significant development. I mean, one wouldn't have ever thought that we'll get to the household level data. And even when the regulations first came in, I was trying to think through how will this happen. But with digital technology, with this ability for MFIs to generate and ask for that sort of data, and for then gradually the bureaus to respond to that data sets and to create those data sets, I think that's a huge positive development. And hopefully the sort of indebtedness levels we have seen would gradually reduce, and the overall objective that RBI has, that the sort of stresses that we see in the microfinance sector may not happen quite as frequently, at least as we have seen in the past. So with that, I'll open the floor. I'd also like Dr. Hegde or Mr. H.P. Singh to weigh in, and if they have thoughts around the modified regulations, I would invite them to say a few words. But otherwise, please, if there are questions, then please just say your name, organization, and to whom the question is directed. here, and then we move to the gentleman at the back.
Thank you very much for giving chance. This is Shohrab Ali Khan, Deputy Executive Director, TMSS. Basically, TMSS is the fourth largest MFI in Bangladesh. At first, I would like to request to answer one question of Mr. Fazlul Kader, Honorable Additional Managing Director of PKSF in Bangladesh. What is the main difference, the aspect of regulation between Bangladesh and Indian microfinance activities? And second question, I'd like to request Ms. Veena, General Manager, Reserve Bank of India, have any limit or capping the ticket size and rate of interest of loan disbursement from MFI in India?
So
Thank you very much.
Yeah, I'd request a 2-minute answer from both the panelists so that we can get to more questions. Kader, over to you.
There is no intrinsic difference. In Bangladesh, as I've told, the targeted population is highly heterogeneous, but we try to reach these people to one single institution called MFI. But in India, they engage different institutions to target this heterogeneous group of people. And if you look into the regulatory framework issued by RBI, you'll find that many issues which may emerge as source of conflict or confusion, very crystal clearly defined. We did the same thing. At the end of the day, microfinance is financial intermediation. Whatever we have tagged with other things, but it's financial intermediation. And they defined it very clearly, which is very crucial in acting as a catalytic role for shaping the sector. So that they have did very smartly, and they have engaged many different types of institutions like banks, MFIs, NGOs, SHG, to serve this highly heterogeneous group of people. This is another approach, but ultimately it is meeting the people's need. I mean, so intrinsically it is not different.
Thank you, Kader.
Basically, your question was related to cap on the loan and cap on the interest rate. I'll say, if you ask a direct question, there is no cap put in by the regulation directly. That is, the quantum is not given, which was given earlier. So now it is linked to the household income. That is the indebtedness, like outflow from the household income should be limited to the 50% in totality. So that is how we have done. So there is no quantum per se. And rate of interest is also not regulated. It is left to the entities. However, there are other checks and balances that I try to give in the limited time, but there are other checks and balances. That is what I will say.
Thank you, ma'am. Yes, sir, please.
Good evening. My question is to Madam. Madam, there is a circular issued by Reserve Bank of India on 19th April 22 regarding the operation of current account. It seems the banks are not properly interpreting. The circular, the main purpose of the circular is, if any NBFC MFI, if they have taken running account, OD or OCC limit, to avoid the diversion of the fund, they should not have the current account in any other bank other than the lender. But in case of term loan, what we are going to borrow from the lender, from that we give to the on lending, that account only will be tagged to the lender, and we are giving kind of what you can say, hypothecation to the lender. In that case, there is no question of diversion of fund or anything. But the banker misunderstood the circular, and they say you should not have the current account for collection purpose in any other bank other than the lender. But if you see, in many of the branches we have MFI in rural areas where you will not have all the banks. Suppose one has taken a loan from X bank, and the X bank will not have the branch.
We got the question.
Okay, okay.
Thank
sir,
you.
Like what you have said, no, that banks are misinterpreted it, and for the collection also they are not permitting it. So which is incorrect. But what I'll say, since you are giving all these details, no, it is very difficult to reply in such detail about the current account, which is not linked to this topic. So I'll request you to forward your whatever complaint or grievance you have, that you can forward to us. We'll respective group will look into it.
Yeah, yeah.
Thank you, madam. Thank you.
I'll invite Dr. Hegde. He has a point to make.
Yeah, good evening. Good evening, sir. Actually, I want to add the suggestion to Mr. Aditya, sir. Sir, you have been telling about getting the household assessment, and especially on the indebtedness part. So already we had given a suggestion to Sa-Dhan. Now I think almost most of the states are using the smart card. In other way, they are telling it ration card or family card. So it has a unique number to which all the Aadhaar card of the household has been already linked. So if we give the loan instead of, we use the primarily as Aadhaar card, but we link the entire thing to the family card number, then obviously we will be able to get the household indebtedness. That is first point. And second thing, and the assessment differs from organization to organization. So why it can be a cross-functional team to have the assessment of a household and then make it somewhere in the website so that everybody make use of the data. This is a kind of suggestion on the first point. And the second thing added to this, there are some organizations who are not the part of credit bureau and they have been continued to lending. So it's also again increasing the over indebtedness. So these two things are pointing to Aditya, sir. And then to Veena ma'am, the one important thing is.
Let somebody else also ask the question. Thank you very much. Thank you. If we have time, we'll come back to you. Otherwise, let someone else.
So point taken on the first one, we can discuss more. And your second point, if there are organizations lending, not reporting to bureaus, you have, ma'am here, please give her the list. She will do the needful.
Yes, absolutely. I mean, yeah. Yeah. So if you bring it to the notice of, an agency, then they can probably take some action. But really, yes, sir, please go ahead. Yeah, Dr. Hegde, please.
Oh, yeah, good afternoon. This is a small observation rather than a question. Thanks to regulator for bringing a forward-looking changes in the earlier regulation, which has helped us to bring down the indebtedness. But at the same time, I am Dvara from NAFINS. Our company is working in 19 states as of now. What we are observing is, as a result of this new regulation, the rejection rate of the borrower has significantly gone up. Earlier, we used to say, if you mobilize, say, 100 KYCs, you used to sanction something like 80 to 85 applications. But today, it is not the case. We are rejecting as high as 50, 55 cases. In other words, what it is reflecting is the people are going out of the poverty line or microfinance, maybe. I don't know whether it's really ground level, that is the real thing, or because of this regulation, they are not going to banks also, at the same time, they are not eligible for the microfinance loans also. So whether they are going back to the money lender trap, that's the one concern I am observing. The second thing is, as a result of these higher rejections, our cost of mobilization, in other words, operational cost, has, I think, at least 10 basis points, it has gone up. That's what our internal informal assessment. This is what I would like to share with the House.
To take this, ma'am.
Rejection rate, really wonder, like you have to tell us the reason, but because we are not in the field, but you are in the field. So you have to tell us why is the rejection rate. We are interested in, not now, but you can forward us in detail.
Sure.
The reason for like the capping earlier, when you say the earlier regulation, no, it was, the loan was for the individuals. It was not for the totality like indebtedness at the household. So that may be one of the reasons. But anyway, we'll be interested in knowing, like if you can tell us the reason why the rejection rate is high.
Let's hear Shalabh on this. I mean, do you see something similar?
No. So rejection rate is an outcome of a process. That if that process is good, rejection rate, let it be an outcome. It does not matter, is my very, very strong view. It is like if I have to go from one road to the other side, the shortest is I jump, right? but you still, there is a rule that has to be followed. In the process, you will take more time, which is fine. Rejection rate goes up because of the FOIR, because of the indebtedness level, for the exact reason why the regulation, change was there. So in my view, I think it is a good thing. Over a period of time, it will stabilize. The cost to income or the OPEX cost that you are mentioning, I think, it will kind of, this is a transition phase, as I say, there's a lot of headroom amongst the, as I said, there are only 70 million borrowers. There's still a lot of headroom in this 1.3 billion country. Thank you.
So I think this is an interesting point of view, but one would always say that, this 3 lakh limit will start cutting in at some stage, whether it happens in a year, 2 years, 3 years. Inflation is going to eat into this. So RBI will have to have a mechanism to revisit this limit is all I can say. But yeah, fair points. We have two different points of views. HP Singh Saab, you would like to come in with a third viewpoint? Please.
Well, I think what Shalabh said was right. I think technically, I think we have to look at overindebtedness as what you rightly said. I think that 3 lakh limit is going to eat away at some point of time. But just a related thing also. I think there's a and this is not related to this. But I think there's one point which is probably need to be looked at the regulator is the qualification norms. The qualifying asset norms. I think it's becoming a little bit more challenging for all of us to operate in that environment because of the asset sign being defined as having even our cash holdings as such. I think that is something which has to be probably looked at in earnest with the regulator, I think. And Shalabh, you can add on.
Yeah. So I completely agree, because the moment you add cash to the qualifying component, it kind of restricts you to borrow. And this is a bit stressful towards, at a point in time when you are being, when you are finalizing your balance sheet, etc. So I completely agree with sir. I think, that part has to be kind of looked at. Rest everything, I think, as far as the customer part is concerned, I am completely for it.
Yeah, I think this point I have heard from others as well. Other MFIs also say that, the whole qualifying criteria. We have 3 minutes. I'll take that one question and then, sir, to you. And please be brief.
Yeah. 2 points. Point number 1, FOIR is highly desirable. But only the paradox is, if the man of the house wants to avail of a two-wheeler loan, he only gives his financials and gets a loan. If the wife of the house wants a 30,000 rupee microfinance loan, then the household income is taken. So somewhere it doesn't gel well. That's point number 1. Point number 2, we have both the regulator as also Aditya from the Equifax. The biggest risk in this industry is staff-induced risk, not the customer risk. Today we have an employment bureau formed by Equifax. The regulator ideally should mandate that every employee is being recruited in a microfinance institution, irrespective of the nature. Could be a SFB, could be a bank. It should be run past the bureau so that we know that we are recruiting the right set of people. Otherwise, the guy or the girl leaves one institution, next day they are joining some other institution, and whatever wrongs they have done in one, they are going to repeat there. And that adds to the pain. The end sufferer is the customer.
Sir, ये सबको मतलब स्कूल टीचर प्रिंसिपल टाइप का चाहिए कि हर RBI सब चीज़ कर दे. I mean, we have the industry association, the SROs, they should really step in for this. But anyway, ma'am, would you like to also play this role on whom to hire and whom not to hire?
Basically, Mr. Manoj has conveyed the thing like RBI gives the very principle-based regulation. So we give certain principle based on which the entity has to act. Like, why do we have the board of the entity? What is the role of the directors? When we have framed the regulation, we have put a lot of onus on the board of directors. Like, they should frame the pricing policy. They should frame the policy to determine household income. So all those kind of things is has to be done by the board. So how do you expect that about the employee also RBI should come out with the regulation? Board is there. They can always, the policy.
The same regulation you are given for the customers, that
Sure.
every month you need to submit data to the bureau.
Just one last question, 30 seconds, we are already out of time, by the way.
One question, I think
I didn't
it's
see
a
you,
short
ma'am.
question. Yeah. So we heard about the reporting of JLG data to the CIC, to Equifax. I think you were talking about the very regular reporting. Now, what about the SHG data reporting? Is it happening? Because as per the RBI instructions.
So SHG data reporting, ma'am, there are some pilots being done. RBI is not aware.
Okay.
It's because the data sits either with banks at a group level, or it is being managed now by state governments through the state rural livelihood missions. There are some pilots, I can tell you, that are underway to see that if this data can be shared. Now, fortunately, we have technology come in at the SHG level, just very recently, in the last 3 to 4 months. So we will now have data, hopefully, God willing, which will track indebtedness at the level of borrowers, and we'll be able to, so this 20 billion outstanding that you see in SHGs, we'll be able to disaggregate at the client level. Yes, sir, because we asked you, then why didn't you just complete it? I'm very sorry, sir, we won't be able to take any more. You'll have to move back quickly, please, sir, and take one of the microphones.
Good afternoon. This is Mohammad Abdulawal. I am Executive Director of Credit and Development Forum, which is a Sa-Dhan version in Bangladesh. We claim that we have been the largest and the oldest network for microfinance in the world. There are two questions. One is, the conventional central bank normally regulate in one way. But the microfinance institutions they have some uniqueness because they work with the poor people who don't have any asset. So I think how the RBI at the moment regulate, because they are not used to regulate this sort of customers. Do you have any challenge in regulating the microfinance institution in India?
Yeah.
Second,
sir, just one question.
I just want to know that
we are really out of time.
Long before there was a bill placed to the Lok Sabha for separate regulation. What is the progress of it?
Yeah, so I think ma'am pointed out that there is a new set of regulations which are much more progressive, but I'll allow her to respond in 30 seconds.
You have talked about experience of RBI in regulating MFI. Since 2011, we are regulating MFIs. And what we have done now is made the regulation uniform across the lenders. That is what we have done, and we call it activity-based regulation.
Thank you very much. I'm sorry we couldn't take all the questions. I hope this was a lively enough panel, and at least there are some takeaways for you. Thank you so much to the panelists. I think a wonderful panel, very diversified. We had experience from Bangladesh. We of course had the regulator who under sort of thinking that went behind the regulations. Shalabh talked about how the regulations are being received, and it's great to see that there is a lot of positivity. Of course, there are areas where we can always improve, as HPC also pointed out. Shalabh seconded it. And then we have Equifax. I think this whole idea of a household becoming an entity, this is just wonderful. The sort of possibilities this opens up is just tremendous. So thank you everyone. Thanks so much for staying put. And yeah, over to.
Thank you, Mr. Sharma, for your excellent moderation, and other panelists for this insightful session. Now I would like to call Mr. H.P. Singh, Chair Sa-Dhan, to facilitate our speakers and Mr. Moderator. To Mr. Aditya Chatterjee. To Mr. Shalabh Saxena. To Srimati Veena Srivastava. To Mr. Fazlul Kader. To Mr. Manoj Sharma. I will request our speakers and Mr. Chairman to pose for a group picture. We'll break for a tea. After this, there will be a 10 minutes break for tea and coffee. After that, we will all meet in the main hall. A request, please check that your belongings are with you, because some of the bags are here which we don't know whom. And if you have missed anything, you can reach out to us. We can help you to.
So thank you so much.